So that's the first 100 days in office. Signals coming from the world's geopolitical stage suggest a lack of trust and confidence in the American empire. Countries are cautiously distancing themselves away from their reliance on using US dollars to settle transactions. It then stands to reason that a weakening USA increases the likelihood of its decline as the world dominant economic superpower by the end of the decade. If that's the case, and we're witnessing a US de-dollarization, our quality of life back here in North America is about to change dramatically by 2030, and the wealth tied to our real estate in Canada will be greatly affected going forward here on out. Hi, my name is Mel Giannone. I'm a commercial real estate broker serving entrepreneurial companies and individual investors seeking property across the Greater Toronto Area. Welcome to CRE Next, Work Out Loud. Here's what happened this week in CRE. Hi everybody, welcome back to a spring edition of CRE Next, Work Out Loud. These are episodes targeting commercial real estate strategists seeking insight into the current commercial real estate market for the Greater Toronto Area. So if you play a role in real estate for your company or transact in commercial real estate personally, then I invite you to help me grow this online community. Please don't forget to like, subscribe, and tap the notification bell so that you don't miss out on any new content as soon as it's released. If you know anyone who would be interested or can benefit from these episodes, please feel free to share the link with them. You can also find us on other social media channels, Facebook, Instagram, Twitter, and LinkedIn, as well as in an audio podcast version of the show. I look forward to connecting with you on these platforms as well. Today's episode will be something completely different, but still relevant to you, the investor. The train will be going off the rails for this edition as I sound the alarm to warn that this time in history might be one of the best times ever to invest in commercial real estate, and that the window of opportunity may be closing over these next few years. The themes for this broadcast cover a high-level stakes politics on a world scale, global economic strategy, international monetary policy, the digital economy, the fourth industrial revolution, and of course, commercial real estate. The idea around today's content originated from the sentiments of this paragraph cited in a Rand Corporation report. The words you see here paraphrase comments made in a Wall Street Journal op-ed piece by a former national security advisor and a chief economic advisor, both serving under the Trump administration. It speaks to truth about how the U.S. envisions its place as a global empire, and the aggressive moves needed to be taken in order to secure economic dominance for the West. They're playing political chess at the grandmaster level. To us here back at home, U.S. foreign strategy over this next decade will seem ugly most times, but its success is vital for the prosperity in Canada, since we export about 75% of our GDP to our southern neighbor. If you're still a bit confused as to how we connect politics to real estate, don't worry, because over these next few minutes, we'll touch on events happening now across the global geopolitical landscape to learn their influences on Canadian commercial real estate. Once better understood, we can position ourselves for greater opportunities here in the Toronto area. One, from a strategist's perspective, we'll talk about future economic conditions that will thrust certain types of real estate forward. And secondly, from an investor's perspective, we'll give you an update on transaction activity in the first quarter of 2021 across the four major asset classes: office, industrial, retail, and multifamily. As always, to make sense of it all, we'll break it down into three parts by looking at the big picture first, the national economy second, and local investment trends. Along the way, we'll highlight some key takeaways for you to consider before summarizing it all and giving you our guidance at the conclusion. Let's get started. want to begin this first section by prefacing I'm a commercial real estate specialist practicing over 25 years, not particularly an expert in international foreign policy, federal fiscal policy, or domestic policy. However, I find these subjects fascinating enough to want to share with you some concerns I have for their potential impacts on Canadian real estate. I'll provide a lot of food for thought, so just for kicks, I want you to enjoy this content mostly for its entertainment value, as my intention is to be thought-provoking and don't mean to offend anyone. So that's my disclosure to you, that's my disclaimer. In previous episodes, we touched on some economic conditions that suggested we're witnessing the rapid decline of the American empire, an international debasing of sovereign currencies among Western nations, favor among corporate globalists back towards the East for profits, and the rise of China as potentially the next dominant world economic power. As in the scene taken from the movie Anchorman, is the West willing to blow up its own monetary system in the fight to eliminate global competition? Since taking office in the White House to declare America is back, the new administration has been unsuccessful in dictating its foreign policy agenda to the world. Initial efforts to restore relations with many of the world's greatest nations has, for the most part, fallen flat. For the first time in recent memory, it seems the U.S. is being pushed around by China, Russia, and since Brexit, getting a colder shoulder from allies in the Eurozone. The West looks divided in the face of its Eastern adversaries, and the U.S. dollar is desperately holding on to its place as the world's reserved currency. Right out of the gate, in January, the Biden administration set its sights to realign interests with trading partner China. A U.S.-China summit at the Captain Cook Hotel in Anchorage, Alaska, foreshadowed the obstacles U.S. foreign policy would have going forward. In an attempt to control the message, the U.S. Secretary of State Anthony Blinken was met with a 20-minute rebuttal from his Chinese counterpart stating, "The United States does not have the qualification to say that it wants to speak to China from a position of strength, and that China no longer considers America the preeminent world power that has the moral authority to criticize China for anything." Later in April, Russian Foreign Minister Sergei Lavrov had recommended the U.S. should stop posturing like a sovereign while rallying its allies against Russia and China. These are very strong words coming out from the East. The U.S. has even struggled to mend transatlantic relations with the Eurozone, who had been viewed as competitors under the last administration. So much so that the Eurozone had looked to strike a free trade deal with China in April and another with India in May. So that's the first 100 days in office. Signals coming from the world's geopolitical stage suggest a lack of trust and confidence in the American empire. Countries are cautiously distancing themselves away from their reliance on using U.S. dollars to settle transactions. It then stands to reason that a weakening USA increases the likelihood of its decline as the world dominant economic superpower by the end of the decade. If that's the case, and we're witnessing a U.S. de-dollarization, our quality of life back here in North America is about to change dramatically by 2030, and the wealth tied to our real estate in Canada will be greatly affected going forward here on out. Certain asset classes of real estate like office and retail will continue to face challenges, while land, light industrial warehousing, industrial data centers, industrial research facilities, and multifamily rental properties will surely become indispensable over the next 8 years. We'll make a case for these types of real estate over the next few minutes. With the coming global economic shift, all real estate, as with all hard assets like gold, silver, and the like, We'll hedge against future volatility coming from the erosion of our own sovereign currency, coming from the certain transition to digital currency, and any anticipated cost inflation coming from the international trade wars. Those are pretty ominous predictions, right? Well, I don't want to be a fearmonger, but like I said, I was going to sound the alarm on why now might be a good time to go all in on real estate. So let's take a look at how quickly the shift to the east is playing out in this first quarter economic performance among the world's richest nations. China's GDP reached 18.3%, while the West collectively struggled to grow to positive numbers. Take a look at interest rates in China versus Western nations who have nothing left to cut in order to boost their economies, while inflation among these countries is already climbing higher than China's. 0% interest rates among European nations basically signals paper money is worthless. Don't keep it parked in the bank. It won't make you any return. After factoring in inflation, you're actually losing value by holding on. In the case of Japan, a negative interest rate acts as if it were a tax on holding paper currency. Lastly, take a look at the debt to GDP numbers that show most Western nations owe more than they can earn. Not the case in China or Russia. The US dollar, used for bilateral trade between China and Russia, had fallen below 50% for the first time ever in 2020. Thus, the brave stance in the face of the West coming from both these countries lately. According to the World Economic Forum, the US dollar share in global foreign exchange reserves fell to its lowest level in 25 years by the fourth quarter of 2020. The US dollar is currently in decline. While Western nations continue to expand their money supply, other major emerging markets have already tapered their levels of stimulus months ago. Over these past 4 quarters, major advanced economies like the US, Canada, and the Eurozone have been debasing their currency at the quickest rate in history since World War II. As a relatively small nation, the global value of our Canadian dollar has diminished quickly relative to other competing international currencies. This weakening purchase power results in rising costs for imported consumption goods or raw materials needed to manufacture products we sell back to the rest of the world. This will only get worse as the money printers continue inflating the supply of Canadian dollars in circulation. As you can see in these charts, the US dollar has been losing ground to its own allies, let alone China and Russia. To our detriment, even Canada has been gaining ground on the US greenback, creating some challenges for our exports. Remember, over 75% of our exports are sold down south. So on the flip side, we might be pressured to print more dollars and keep interest rates low, so our exchange rate stays in line with the US dollar. The sad reality is we're stuck in a loop that suggests we may have to keep printers going nonstop for a long time towards inevitable monetary collapse. That's partly why we hear chatter about the fourth industrial revolution, or insight from our Prime Minister about a great reset, or from the International Monetary Fund encouraging a new Bretton Woods system, or the World Economic Forum leading governance over central bank digital currencies, all in an effort to prevent that from happening. But guess what? China is already at the testing stage of its new digital yuan currency, which eliminates the need for paper money and, more importantly, the ability to decouple itself from the need for banks altogether. With the digital yuan, China will be able to grant permission to, restrict access from, and transfer funds directly to its citizens. It'll be able to settle transactions internationally much quicker than the West, and also bypasses the SWIFT banking system, a payment and clearance system that tracks interbank transactions predominantly controlled by the US. The West often uses SWIFT to enforce sanctions on countries that don't play along. So this is why the rebuttal back at the Captain Cook Hotel in Anchorage, Alaska, that heard Chinese State Councilor Wang urge the US to abandon all the hegemonic practice of willfully interfering in China's internal affairs. You see, maybe it's not about the West's concern regarding the Huawei executive held in Canada, or the investigations of the origins of a virus in a lab in Wuhan, China, or the protests in Hong Kong. Maybe it's not about the merits of sovereignty for Taiwan, or maybe it's not about the fate of the 12 million Uyghur Muslims that the West professes it worries about. And maybe it's not about the environmental pollution caused by Chinese use of fossil fuels for generating energy. Perhaps it's really about China's huge competitive advantages in the global arena and the West's attempts to slow down its rise to competitive dominance. It's more likely that the West is concerned about how far ahead China is exporting 5G, 6G infrastructure technology, how advanced their 5G cities are for business relative to the West, the access to banking and investment capital that resides in Hong Kong, Taiwan's huge semiconductor industry that China processes up to 65% of the world's cryptocurrency, of which 36% of that total comes from the Xinjiang region through the exploitation of cheap labor using Uyghurs and other minorities. These advantages give China power to accelerate the growth of its economy much faster than the West. Remember that 18.3% year-over-year growth in Q1? The remote region of Xinjiang is abundant with cheap, dirty coal, while China's Sichuan region provides an abundance of cheap hydroelectricity for mining crypto. In all, Chinese mining pools control 50% of the crypto network. China could regulate the output of Bitcoin, Ethereum, and the like, while at the same time using them as a commodity to back the value of the digital yuan. Actions in mid-May saw the Chinese government ban institutions like banks and online payment channels from offering any crypto services that would compete against the efforts to control that space directly through government means. However, China did not bar individuals from holding cryptocurrencies, which further instills the possibility that cryptocurrencies will be used by their government as a commodity to support their digital yuan. So, unless the West speeds up the development of their own digital currency, which is expected in about 4 or 5 years or so, we should consider leveraging our cheap fiat paper money, currently being debased, by reinvesting it into hard assets like real estate before its value becomes eroded to nothing and the cost in purchasing real estate inflates beyond most people's affordability. Alarm bells are ringing. Now might be the most affordable time to invest in commercial real estate before it becomes unattainable for most small entrepreneurial investors. Inflation will erode value. Real estate is a hedge against that erosion. Although you may not achieve extreme levels of capital appreciation across all types of real estate over the next few years, as some have already approached peak pricing, all types of commercial real estate will generate cash flow. And this is the most important attribute to focus on during the volatile periods of economic transition. Real estate offers calm, control, and consistent returns during periods of turbulence expected over this decade. Here again, I wanted to take the time to mention the erosion of our Canadian dollar might not be obvious to you because in relation to the greenback, Western nations are linked to the US dollar's performance, so it's masked to some extent. Our economies are all rising up and down in unison, but looking closer at these charts, you'll see even the Western currencies have risen against the current world reserve currency since the start of the pandemic. Canada has been losing ground to the euro over this past year since the start of the pandemic crisis. The US might be stuck in a debt spiral as China holds much of their debt. Over the last 30 years, traditionally, China would promise to purchase US treasuries, and the US would export jobs in manufacturing to China in return for the imports of cheaper goods, thereby concealing true domestic inflation. They previously done this with Japan post-World War II. The US would use those investment dollars to fortify its military strength and banking system to ensure the use of their currency as the world reserve currency. Think Saddam Hussein in Iraq, Muammar Gaddafi in Libya, and Nicolas Maduro in Venezuela, all threatening to use alternate currencies for settling transactions in the trade of oil. This is called hegemony. But now, traditional holders of US debt, Japan, China, and the UK, are selling off treasuries. So the US is seeking to find new investors to play the trading game with. Take a look at India's commitment throughout the past year, almost up 28%. Have they been selected by the West to replace China's former role? If so, this could be a way out of peril for the decline of Western nations. Look for India to play an increasing role in manufacturing and trade to the West. If you're an owner of commercial real estate, you may want to seek out new tenant relations with some of India's biggest companies, as they surely stand to benefit from new cross-Atlantic trade relations and will most likely need to have a physical presence here in Canada, definitely within the Greater Toronto Area. Here lies the problem. The West needs China more than China needs the West. China is no longer depending on the US and European markets for exports as they roll out their Belt and Road Initiative for global trade throughout the rest of the world. The goal for China is to be reliant on its own national demand as the country grows its middle class over the next 100 years. However, the US dollar still needs China investment now in order to continue printing money and growing the US economy in the short term. China poses a security risk in that it can potentially tank the US dollar by curbing its purchases of their debt or selling off their debt, making the US pretty vulnerable in high-level foreign policy discussions, like the one at the Captain Cook Hotel. The continuing wealth decline amongst US citizens ensures American dependence on cheap manufacturing from overseas. US corporations will pressure government to continue outsourcing jobs to countries with cheap labor and lax regulations in order to maximize profits. Wealth managers like Citigroup, JP Morgan, Goldman Sachs, and asset managers like BlackRock, Vanguard, and the Carlyle Group will likely lobby their government for a return to globalism desired for maximizing private equity returns. That ideology is a huge departure from the last administration in the White House. Like a drug addiction, this continuous loop of codependency on the East to generate short-term economic stimulation will lead to long-term depression of currency value, inevitably guaranteeing the implosion of economies among the West. The U.S. is not exclusive to this corporate pressure. In his May 20th presentation unveiling the most recent financial system review summary, Governor Tiff Macklem warned twice about the structural liquidity vulnerability in the debt funding markets, once at the 9-minute mark and then again at the 34-minute mark when answering questions. The Bank of Canada has learned over the past decade that potential demand from asset managers for market liquidity in periods of stress have outpaced the capacity of banks to provide it. I'll repeat that. In essence, as is the case in the US and within the Eurozone, the asset management industry in Canada has grown bigger than the banking industry itself. And in their search for high-yielding returns, asset managers have moved off government and corporate bonds into other moderately safe assets ranging from real estate to infrastructure, which tend to be less liquid, therefore hard to divest from in times of crisis. Due to the low interest rate environment over the last decade, in some cases, the asset management industry also uses leverage to boost their returns by drawing on their lines of credit, which increases liquidity demands from the dealer banks, making it difficult for them to keep up with the spikes in times of stress. The central bank, the Bank of Canada, is the market maker of last resort in this case. So in other words, the asset management industry is too big to fail. They pose a systemic risk because they are invested in a diverse array of alternative assets that drive the economy forward and are the custodians of wealth in many Canadian pensions. So with many businesses relying on fragile, high-yield debt markets, that adds pressure on the government to keep printing money so as to keep interest rates relatively low for a very long time, so as to provide enough spread between risk and return for asset managers, as well as to eliminate all the new debt that has been created over the last year. Over 26% of which had been added since the start of the pandemic, representing about 27,000 for each of us in Ontario. With all this liquidity injected into the Canadian economy, we can expect increasing velocity of money circulating to add inflation or temporary hyperinflation. Measured against rising inflation, real earnings and wages in North America are likely to decline over this next decade. Affordability in North America will be challenged, which means we're currently living out a race to the bottom since we can't cut costs down further, or raise interest rates, or introduce sweeping taxation on the backs of citizens. What you can expect to continue is the exportation of jobs and sacrifice in quality of goods in favor of cheaper goods and services of which we can afford to consume or implement in manufacturing of end products for export. We'll continue to see the growth of the digital economy replace the human labor force with as much technology to drive costs down, especially among low-income wage earners. We'll continue to sell off large amounts of our sovereign debt in order to print more fiat currency to keep interest rates low and the cost of borrowing money affordable. We'll continue to experience bubbles in housing as demand outpaces supply for single-family homes as a principal residence, further widening the gap between existing asset owners and those without, especially when the targeted 1.3 million immigrants start arriving in Canada over the next few years. We could very well become a nation of renters in the residential markets, as the cost of shelter, which sits above 3.2% year over year in April 2021, rises faster than real wages earned by most Canadians. I'm optimistic for the condominium and purpose-built apartment asset classes, especially as the health crisis subsides past 2021. So, multifamily residential will be an asset class you need to consider investing into for long-run returns. The whole process of providing low costs of capital in an effort to boost returns dangerously loops into a downward spiral until a point where inflation can no longer be concealed from plain sight. It'll show up in every sector of the economy, currently from supply shortages for products manufactured overseas, but especially more so when rising real wages in China are reflected in the cost of our imports. That is why Western nations are focusing on immigration into their countries and are pivoting away from China towards India in order to capitalize on their cheap labor and skilled workforce. The illusion of prosperity must continue, or else the house of cards falls. So who wins And other than multifamily, what other asset class of commercial real estate looks like a winner? Let's take a look at who has benefited over these past 12 months. Well, according to the World Economic Forum, the top 50 companies can be broken down primarily into 5 sectors. 1, tech software and social communication platforms. 2, tech hardware and infrastructure providers. 3, the pharmaceutical sector. 4, the direct-to-consumer goods and service retailers adopting to e-commerce and online shopping platforms. And 5, auto manufacturers, specifically those tied to hybrid or electric vehicle platforms. 6, this might be closer to home and not shown on the list, are infrastructure companies, the likes of engineering firms and construction companies that'll benefit from the most recent federal budget. So here now are some key takeaways if you're an investor of commercial real estate. You want to consider the types of properties that cater to these growing industries. In the case of tech software and social communication platforms, you may want to purchase assets close to knowledge centers like colleges, universities, and a younger demographic of newly graduated students. Locations like the Tech Triangle between Cambridge, Kitchener, and Waterloo come to mind. This is a region with good infrastructure for internet connectivity and affordable housing, which make it a sure bet for growth. Secondly, in the case of tech hardware and tech infrastructure providers, you may want to purchase industrial assets in locations close to urban cores that have a huge capacity for industrial space for the use of data centers while close to abundant, reliable power sources. Locations surrounding downtown Toronto like the Portlands, Etobicoke, Mississauga, Vaughan, and Markham. Microsoft's recent acquisition for land and retail surrounding Toronto reflects ambitious efforts to become a big player in the cloud data services space. Number 3, the pharmaceutical sector. You may want to consider research and development facilities in Mississauga's northwest corner of Meadowvale, affectionately referred to as Pill Hill, or Mississauga's Sheridan Research Park. How about McMaster's Innovation Park, located in Hamilton? It's designed to cater to biotech and life sciences research, so the areas around this park might be a good place to shop for property. 4, in the case of some consumer goods and service providers, you may want to focus on locations along the fringe of the urban cores, catering to the last mile delivery of products. Growing areas like Brampton, Milton, and Caledon come to mind for recent transactions like that for Amazon and Walmart. As for infrastructure companies working to upgrade our road network, follow the path laid out by Metrolinx for the greater Golden Horseshoe area. These companies will require land, office, and industrial locations all around the GTA in close proximity to their ongoing projects. Well, we've given you our guidance on what types of real estate pose the best returns over the near future. So now we'll show you what you can currently expect as returns for each asset class. The Greater Toronto Area, Q1 2021, saw the largest first quarter year-over-year jump in investment activity on record. Over 600 transactions totaling over $6 billion equated to a 56% rise in value over last year's opening quarter. Land was a big winner in Q1, representing over half of the value in transactions of approximately $3.2 billion. Industrial assets were next best, representing $1.4 billion and approximately 23% of the transaction value. Multifamily and food-anchored retail strip malls ranked next in demand with transaction values at very similar levels to each other. Office was the only or the lone asset class to see a decrease in transaction volume in Q1 by approximately 18%, while hospitality assets saw a glimmer of hope in bouncing back off its investment demand lows. As the Bank of Canada announced it would begin to taper its quantitative easing bond purchases to $3 billion per week starting April 26th, we saw the preemptive rise in the Bank of Canada 10-year benchmark rate by the end of the first quarter 2021, placing some upward pressure on interest rates, but not enough to draw the big money out of the stock market, precious metals, and cryptocurrencies. As a result, a large allocation of portfolio funds among investors remained dedicated to commercial real estate, much of those funds still waiting to be deployed. We saw capitalization rates in the GTA compress slightly and trend relatively flat throughout the first quarter, as investors cautiously negotiated the bid-ask gap between buying and selling property. The overall average cap rate expectation across the four major food groups, office, industrial, multifamily, and retail, sits just over 4% and should remain in that range at least until mid-year 2021. Again, let me reiterate my argument for purchasing commercial real estate at this time. It's not solely because of the opportunities in capital appreciation. Looking at an average cap rate return at just over 4% these days doesn't appear as exciting at face value when inflation is set to rise above 2% over the next few years, thereby eroding some of that real return on equity. Perhaps you can make a case for other types of volatile investments that could provide double-digit returns in the stock market, precious metals, or cryptocurrencies that are all more liquid than real estate. But commercial real estate offers the opportunity for forced appreciation on your assets through capital improvements, leveraging today's depreciating dollars into upgrades that exponentially appreciate the value of your asset. Commercial real estate also offers the opportunity for passive appreciation through the rental cash flow of your tenant leases, which should rise to match or return more than the rate of inflation. In times of volatility, real estate can be both an offensive investment strategy and a defensive hedge against risk at the same time. Going forward, as we come out from the recurring shutdowns, we can expect transaction volumes to increase and cap rates to compress. Investors remain flush with cash, waiting for the economy to reopen fully. The Bank of Canada has provided a lot of liquidity in the Canadian economy, in which, given the right investment opportunities, will eventually increase the speed at which money circulates in the economy. They've also revised their guidance to announce that they would hold rates until the second half of 2022, which has been moved up slightly from 2023 due to their positive outlook. So there you have it, a diverse cross-section of economic themes that encourage caution, vigilance, opportunity, and hope, all wrapped up into one episode. Here now, as promised, we've recapped all the key takeaways from this episode in the following bullet points. 1. Watch for signs of the American empire influence on the world to decline unless the new U.S. administration can rally the West together as one influential economic bloc to compete against the rise of China. 2. Watch for signs of a highly indebted global economy and an international debasing of sovereign currencies among the Western nations, potentially ushering in a great reset and a new form of Bretton Woods agreement involving digital currency and a universal basic income. 3. Watch for signs among corporate globalists to court India as the replacement for China's role to consume U.S. Treasury debt, provide cheap labor, skilled trade, and low cost of consumer products. 4. Watch for the rise of China's digital yuan to be countered with digital currencies regulated by the West and still anchored in some way by the US dollar. 5. Watch for transitory inflation to affect the Consumer Price Index in Canada over the course of 2021 before stabilizing in 2022. But be forewarned of the points discussed in this episode. If inflation persists beyond next year, it could mean hyperinflation or stagflation will set in. All the more reason to invest in real estate as a hedge. 6. Watch the money printer go brrr for a long time until we can recover all the economic slack caused by the pandemic. Again, be forewarned if excessive printing continues past 2022. It could mean more asset bubbles could be formed in real estate, the stock market, precious metals, or even cryptocurrency. Number 7, watch for the growth of the digital economy to erode the low-skilled, low-wage, and part-time jobs in retail and hospitality, driving a wedge through the middle class, creating a split between those who are fortunate enough to acquire hard assets like real estate versus those without, potentially creating a nation of permanent renters. Number 8, watch for continued growth in tech, pharma, e-commerce, online shopping, logistics for last-mile delivery, and infrastructure sectors of the economy to drive down supply for commercial industrial and flex industrial real estate. Number 9, watch for the Canadian borders to open up by 2022 for the tsunami of overseas immigrants waiting to arrive, driving up demand for rental housing and single-family homes around the GTA. Number 10, watch the pent-up demand from institutional investors and asset managers continue to deploy dry powder capital into the industrial and multifamily sectors throughout 2021. Lastly, watch for discounted opportunities in the slow recovery of office, essential retail, and hospitality asset classes of commercial property. Well, that's all for this episode. Hopefully you found entertainment value in the data presented here, along with the insight into current market conditions, trends, and knowing what the future might look like. My goal is to help you save or make lots of money through these episodes of CRE Next, Work Out Loud. Please don't forget to like, subscribe, and tap that notification bell so that you don't miss out on any new content as soon as it's released. If you know of anybody who can benefit from these episodes, please share so we can grow our community. You can also find us on other social media channels like Facebook, Instagram, Twitter, and LinkedIn, as well as in audio podcast versions of the show. I look forward to connecting with you on these platforms as well. Thank you for your time. For real estate opportunities together, I can be reached by telephone at 905-567-5602, by email delivery to mel@paramountrealestate.ca, or communicating through the comments section if you're watching by video or listening via podcast. Until next time, stay well.